Compound Everything, and we talk investing and markets and money. And this week we are talking about a company called
Alimentation Couche-Tard.
Right. And the reason we are talking about particular companies is because one, we're actually looking into this company. Well, you're looking into this company, I'm not. And two, we're kind of running through our valuation methods using discounted cash flows, DCFs, and possibly owner's earnings if we get to that today or not.
So what is this company? So this company is actually a series of convenience stores and fueling stations. The name means food for those who go to bed late, which is kind of a funny...
So what is it called in French?
Alimentation Couche-Tard.
So it sounds much better in French than it does in English. And translated into English,
it's food for those who go to bed late.
Okay, got it.
Or nutrition for those who go to bed late.
I don't know many convenience stores that sell nutritional items,
right.
But, you know.
So what is this company? So in Canada, it's...
is it a Canadian company?
So it's based in Canada.
Hence the French.
Right.
The French name.
So I believe it's in Quebec is where it's kind of based. And they have about 14,000 stores worldwide.
Okay.
Which is quite interesting. So they have a lot in Canada, in the US. I broke it down actually. So they have 9,000 stores in North America, Canada, and US, 2,700 stores in Europe, 363 in Hong Kong, and 1,800 stores under the Circle K banner elsewhere. So Mexico, UAE, Cambodia, a few other places.
Okay. And how did you actually come across this company in the first place?
Well, there's Circle K's around us. So there's lots of them. In fact, whenever we go to Shell to fill up, that's one of our gas stations. There's a Circle K attached to it.
Right. So you were probably filling up at Shell one day, and then you were like, "Hey, I wonder if Circle K is traded publicly."
I think I also
I would have always just lumped Circle K in with Shell.
Right.
Right.
So I think I saw an article on it at one point. There was an article that came up. I can't remember, just some news feed, and I was like, "Huh, yeah, okay, I should look into them again."
Yeah.
I had seen them before.
You've been looking at them for a while, because I know that we pulled up a while back, because it's closed down now. We pulled up to a Max convenience store, and you said, "Oh, hey, did you know that this is publicly traded?" So you've obviously been kind of putting your feelers out for them for a little while now.
Right. So they're basically a series of gas stations and convenience stores. And so they run really three, but the third segment is really very little income. But they really run two segments. So they run a merchandise and services part of things, so which is like convenience stores really, which is where they sell things like food, and they sell lottery tickets. They might sell like licenses for various things, tobacco products, and that kind of stuff. And then they also sell fueling and transportation fuels.
Right.
Is what they call it, some gas. The merchandise and services represents about a quarter of their income. The latter part, the road and transportation fuel part, takes up about 3/4 of their income.
Okay.
So their bread and butter really is selling gasoline and that kind of thing.
Okay.
So, which takes you to kind of one of the risk factors for this company, which is if you believe that electrification is going to be a big thing, then 3/4 of their income,
that's a big hit,
is maybe a big hit down the line. So
now, are they trading at a discount? Is that why you've been much more interested in this company?
Well, I don't know. That's why I did the valuation.
Oh, so you're just going to leave us in suspense.
Right. Yes, I am.
See. Okay.
It's a large company. I think it has a $60-some-odd billion market cap. Last year's sales were somewhere in the realm of $60 billion. So it's trading at a price to earnings around 17. Now, over the past 10 years, though, they've had a phenomenal growth rate. Something like, I can't remember what it was, something like 900% or something.
Oh, wow. That is crazy.
It's huge. So, I mean, if you had jumped on this company early, then you would have made a lot of money. So the question is there still value?
Right. Does the management address the issue of clean energy and gas? And
they do. They're moving towards electrification, which is happening heavily in Europe. I don't think it's really made much of a dent in the revenues yet.
Right.
So
I was going to say, how was that looking for them?
So I read last year's annual report, and it doesn't seem like it's made much of a dent in terms of.
And that could be also because a lot of people aren't even
driving electric vehicles. Yeah.
Right. So it's not so much that it's not working out for them; it's that it's just a very small segment of the population.
Yeah. So you could look at it in one of two ways. One, this could be a headwind for them if they don't make the same margins they do on gas as they will in electricity. Or two, actually, because this is a kind of a big area where there's going to be a fair amount of change, maybe this will be a good thing for them.
Right.
Who knows?
Right.
The other thing to know about this company is actually the founder is still on board with them. He's still the executive chairman, I think, of the board of directors. So
but not the CEO.
But he's not the CEO. The current CEO has been around for about 8 years.
Right. And one thing that you had mentioned in passing is how long the shareholders letter is.
Oh, it's quite lengthy. Like it was the CEO's report to shareholders was, I mean, it's a bunch of pictures and window dressings that go along with that. But
you can get rid of all that.
But it was probably a good 10, 15 pages all in. So it was quite a comprehensive letter, and he addresses a lot of what makes them tick.
Which is what we like to see.
Yeah,
we like to see that.
So with the current CEO having been there for the past 8 years and seeing that kind of explosive growth that we've seen, he actually is fairly competent. Right. So that kind of gives you confidence in a sense as a shareholder that this guy kind of knows what he's doing. And we talked about this in prior episodes where, how do you evaluate management? And one of those ways is by how's their track record.
Right.
So he's got a pretty darn good track record.
Right. We really love when founders are still involved. We prefer CEO founders. But even if the founders are still on the board of directors or whatever, we really love to see that because they don't want to see it fail. They've worked there generally their entire life to...
Yeah. Well, I was going to say the next best thing to a founder CEO is a CEO that's been there with a long time with a good track record.
Exactly. Yeah. And here you have both. So that's good. And we don't own it. Well, I don't own any of this.
No, we don't own any shares.
We don't own any shares of this. And this is not investing advice. It's just for fun.
Yeah. So the management, going back to management for a second, one of the ways that management is trying to continue to increase shareholder value is through accretive acquisitions. Last year, or in 2021, they had 12,264 stores, and they managed to increase that to 14,008 stores, I think it was, at the end of 2022. So they are still growing. So it's still a company that's growing over time, which does become of importance because those are things that we use in our growth rates, in our growth projections, as we're trying to evaluate the company.
So they are growth by acquisition a little bit.
There are a lot of growth by acquisition.
Which is interesting because I find that companies that are growth by acquisition can either be really, really great or really, really horrible.
Yeah.
And it takes quite a management team and it takes quite a company to be able to acquire other companies and make those new companies work within the existing company. That is quite a talent.
Yeah. You have to have a good culture in that company and keep that going. Now, their strategy depends on the market they're in. So in their shareholder letter, they say that the United States market, the U.S. market is quite fragmented. And so they're doing quite a number of acquisitions in the United States to try and...
Like convenience stores are quite fragmented.
Correct. Yeah, that industry is fairly fragmented. They're trying to consolidate that a little bit.
Right.
In Canada, it's less fragmented. There's there's far fewer but larger players. And a lot of them represent integrated oil and gas companies. And a lot of those guys are actually selling some of those assets off.
Okay.
And so they're evaluating that strategically as to whether that makes sense for them to acquire.
I was going to ask about that. I was going to say, how come these gas companies don't just have... Because oftentimes convenience stores are at a gas station.
Yep.
Right? Not always. There's standalone Sevs, and which are 7-Elevens, for those who don't know. And then there's standalone... There used to be standalone Max, which you said are now Circle K.
Which is now Circle K.
But now they have put all of those at Shell. Generally, right?
Yeah, I think there's some standalone stores.
At least where we live, there's few standalone. But I was going to ask, why don't the oil and gas companies just have a convenience store? They just don't want to be bothered with it?
Well, I think a lot of them do, but I think a number of them are divesting those ones. So, for instance, one of the larger players here, Husky, is selling theirs off.
Right, and this company... I have no idea how to pronounce it. So
Alimentation Couche-Tard.
Yeah, that one. This one.
Or ATD.
ATD. So they're buying it. They're buying these companies up.
Yeah.
Okay.
Yeah. So at this point, we'll go to the valuation that we did. So,
we're going to do a discounted cash flow again. I know last week I said we do owner's earnings, but I think we're going to stick with the DCF for one more company. Yep. And then maybe we'll go on to owner's earnings and we can do companies that I'm looking at.
For sure.
And then we'll run... owner's earnings. One thing we were talking about today prior to coming on and recording ourselves is that you don't actually really use owner's earnings.
Not really at all.
Yeah. And it's I use it all the time.
Right.
So since this is your company and you've been looking at it and I know very little about it, we'll let you run your DCF and you'll go through the numbers and what you did, how you got to them.
Sure. And
kind of explain to our viewers why you got the valuation you did.
So basically what I did is I looked at the growth rates over the past 9-10 years or so. And the growth rates I like to see are revenue growth rates and then earnings per share growth rates. Those are the things I like to see.
Those are the two most important.
Yeah. So in terms of growth rates, I based on a number of factors, I gave them a 7% growth rate over the next 10 years, which may be a little lofty, to be honest, because that then implies, if you're implying a 7% annualized growth rate over the next 10 years, you're saying that those 14,000 stores are going to go to 28,000
That's
stores.
crazy.
That's pretty big.
Yeah.
And so
Now,
that might be a lofty goal.
Just for comparison, how many McDonald's are there?
No, I don't even know.
Okay, so maybe a better comparison other than McDonald's would be 7-Eleven.
Yeah.
Because
They do very similar things.
things.
Sometimes
Okay.
there's gas stations attached, etc.
Yeah.
And they sell a lot of the same items.
Exactly. So I just Googled 7-Eleven here.
Mm-hmm.
I said, how many 7-Eleven stores? I asked Siri, how many 7-Eleven stores are there in the world? And they said there are 78,029 7-Eleven stores operating as of November 2021.
Well, maybe there's room to grow then.
So there you go. Yeah.
Yeah. So that is their competitor, one of the direct competitors.
7-Eleven does have a durable competitive advantage though where we live. Like
Yes.
everyone goes to Sev.
Yeah. So there's maybe room to grow there.
Yeah,
So,
exactly.
you're comparing 14,000 to 78,000.
Yeah.
That's room to grow. Yeah. So I looked at a 7% growth rate, which has been historically what they've managed to achieve, and so that's the number I used.
So 7% you said would take you to 48,000 stores after 10 years. 28,000 stores.
Yes.
Okay. So 7% would take you to 28,000 stores about over
Thereabouts.
10
It
years.
would double in the next 10 years.
Right. And 7-Eleven has almost 80,000.
Correct.
So maybe you're not being
Maybe
too...
I'm not. I don't know. So you have
Right.
to examine your assumptions. How realistic are they,
Right.
etc.
7-Eleven's also publicly traded.
That is true. They are publicly traded. I think they're a Japanese
I was
company.
going to say, I think it's an Asian
Yes.
company. I'm not sure exactly where.
Yeah. So for this company, I did a 2-stage growth rate. The first stage of growth I assumed would be about 7% over the next 10 years, followed by a kind of terminal growth rate of 3% thereafter, accounting for kind of increase in revenue based on inflation, et cetera, et cetera. So if you take that number and then you discount it by 15% as a hurdle rate, which is what we say we do, you end up getting a per share price of about $31.50 American dollars.
So you're doing this in USD?
I did it in both. I just
I
transferred it over.
Okay.
So about $31.50 American, because actually all the revenue's outlined in US dollars.
Okay.
So, which is one of the things to watch out for when you're doing a valuation. And in Canadian dollars, that represents about $42 and change.
Dollars just doing
Yes.
not as good as it was.
No, it's not. So from that standpoint, Alimentation Couche-Tard as of today was trading at about $64.
Okay.
So that tells me right now, maybe I'll hold off because it's not going to give me the return I'm hoping for at this point. If you either play around with the growth rate, if you thought maybe the growth rate was going to be better than 7%, if you thought it was going to maybe be 10%, or you thought that you'd accept a lower discount rate because maybe the company's more stable and things like that, you could play around with those numbers and you might get a better purchase price. Who knows?
Yeah, and this is why it's so important for the investor to really do their own homework.
Yes.
Right? Because you might attribute a growth rate that you think is appropriate. It might be very different than what I think is appropriate for the exact same company.
Yeah.
Right?
Now, some people may argue that a 15% discount rate is lofty, and I agree it is. That's the return I'd like because I'm investing in a single stock, which has more risk than the broader market.
Exactly. So you want to be very careful.
Yeah.
Yeah. Now, this was a discounted cash flow, which we've talked about before and went into more detail last week. So obviously, if I was looking at this company, I would use the method on my financial calculator that I did last week. I do the exact same thing, but I'd be running it with different numbers.
Yep.
And I probably would come up with a different growth rate than you because we do it just a little bit different. Now, I would also run owner's earnings on this company, which you don't really use.
No.
And owner's earnings is one of those things that some people like and some people don't. I know there's one podcast we listen to, and the guy who does it, he actually doesn't understand why anyone would use owner's earnings. He says that the reason Buffett even alluded to it, I think it was in his 1986 shareholders letter, where it was kind of the first time that this idea of owner's earnings came out. He said it was he was buying a full business, and he was explaining to them why he thought the business was worth what it was. And he said, this is how I got it, and it was owner's earnings. And everyone jumped on that. Oh, this is how he values companies. And this one guy that we listen to, he just doesn't see it as being beneficial to an investor when you're not buying the whole company.
Right.
I, on the other hand, love owner's earnings. I look at buying every business as if I'm buying the whole business. So it makes no difference to me as to whether or not I'm buying one share or
Right.
buying 100 million shares,
Right, that makes
I
sense.
really like owner's earnings.
Yep.
So owner's earnings is just what is left over, what is the money left over in the company that is going to come back to the shareholder.
Right.
And you kind of look at it like, as a shareholder, how much money is left for me? And the way that I really, really love to use owner's earnings is likening it to a 10 cap for a house, for real estate.
Okay.
Right? So if we were to buy a house and we were to have renters, and we were to run all the numbers and look at the cash flow, we would want to know what would we have to pay for that house and what would we have to charge for rent and everything else to make sure that we got our money back in 10 years.
After expenses.
Right. And when I run owner's earnings, that's what I'm looking at. I'm looking at if I actually bought this entire business,
Right.
what would I have to pay for it in order to ensure that I'm going to make my investment back in 10 years?
Right. That makes sense.
Yeah. So we'll maybe get into that next week.
Sure.
That's very, very brief, but that is when we talk owner's earnings. That is what we are talking about. And like I said, the first time that it was brought up by Buffett was in his 1986 shareholders letter. And I think he revisited it around 2014, around that time. There is another shareholders letter around 2014 where it gets brought up again. But 1986, that was the first time that he mentioned it. And that was a big deal for self-taught investors.
That makes sense.
Yeah. And you'll find it in the Warren Buffett way as well. So
So before we go, why don't you run it quickly on the calculator? See if you
Okay.
get some numbers similar to what I got.
Okay, and honestly, it is very quick.
Okay.
It goes quick. And here's the thing: once you do all your research and you've done all the things that you need to do to see if you understand the business, running the numbers is actually the fast part.
Right.
It is the research that takes a long time.
Right, and that's fair.
Yeah, the research takes a long time. The numbers, that's the easy
They're
part.
quick, yeah.
So I just need to look at your numbers here. If these are all correct, I can use them because I'm just going to actually use your EPS just to find the growth rate that I would like to use over 9 years you have there.
Yep.
So 16.33% is what their EPS growth rate has been over the past 9 years.
Right.
So I'm going to say, I don't know anything about this company.
Yep.
You said 7. I'm just going to take this, cut it in half and say 8.
Sure.
So I'm going to go a little higher than you.
Okay.
Even though I know nothing about it. And this would be a terrible way to invest.
Okay, fair enough.
So I'm going to give it a growth rate of 8%. So
Okay.
I'm going to take the current EPS, which is 2.81, and I am going to put that into the PV as a negative. You
Yep.
always got to remember to put that negative. I'm going to give it a growth rate of 8%, and I'm going to say project out 10 years, and that's going to give me 607 as a future value. Now
that's a future earnings per share of $6.07.
Yes, but I'm going to multiply that by a number, and this
The
number
most
represents a PE.
Yeah, their most recent PE is somewhere around 17.
17. Okay, so let's just multiply it by 15 just to be a little
Sure.
bit more.
They're a little bit more mature. People aren't
Sure.
willing to pay as much for it.
So that gets us a future value of $91.
Yep.
So I'm going to take that $91 and I am going to say that that is our future value, FV. I'm going to say that, again, we want to go out 10 years and we are going to use that 15% discount rate because we never ever change that number. And we're going to get a present value of $22.49.
So a little less than I got.
A little less than you got.
Yeah.
Even though I gave it a bigger growth rate.
Yes. Now keep in mind those are US dollar prices.
Yes, those are US dollar prices.
So
but
I got something around of 31.50.
yeah, but it shows you a couple things. One, how the numbers change the valuation because actually our numbers are quite a bit different. Your number is like 30% more than mine, I think.
Yes, it was.
Right?
I got 31.54 USD.
Yeah. So, and yet I used a bigger, it also shows you like I used a bigger growth rate.
Yeah.
But I really punished it with that low PE.
Yes, you did. Yeah.
Yeah. But it also shows you just the difference. You went out infinitum and I only went out 10 years. So there's a lot of things that are different. Yeah. One thing for me, when I do different valuations, what I do is I always pick the lowest one.
Right.
To go with.
That makes sense.
Yeah. Everything I do, I always do it leaning towards being more conservative in investing.
Now, in investing, you're trying to predict the future because the past has already happened.
Exactly.
And so when you're doing that, nothing's going to be exact.
Exactly.
Things will never play out exactly as you hoped. So you've got to make allowances for the vicissitudes of life, as Charlie Munger would call it.
So going back to ATD.TO, you've said there's been a lot of share buybacks.
Yeah, they're buying back quite a number of shares. They filed for a normal course issuer bid, which is basically where the company is allowed to buy back a certain percentage of its shares over a period of time, usually about a year.
And we love share buybacks.
We love share buybacks.
And actually Warren Buffett actually went off a little bit recently.
Yes, that was interesting,
calling out people who don't like share buybacks.
Yes, in his most recent letter.
Yeah, and he usually doesn't get political, so this really bothers him.
Yes.
Because he's just not a fan.
what do you call them? Silver-tongued demagogues.
Yeah.
I believe is what he called those people who are vilifying share buybacks.
Share buybacks. And we've talked about share buybacks before, but that is one interesting thing about this company is how many shares they want to buy back.
Yeah. Well, I mean, it makes sense. If the shares are, I mean, really what you'd like to see is management buying back shares at a discount. So for us at this point, the fact that the management is buying back shares would tend to conclude that they find that the shares are at least fairly valued. And I mean, maybe they're not using the same...
If you trust the management.
If you trust the management, which I mean, we said already that we probably should, given the track record over the past 10 years, and the current CEO has had a 8-9 year tenure.
And the founder's still on the board.
And the founder's still on the board, et cetera, et cetera. So at the very least, they think it's probably fairly valued. Now, granted, they're not probably looking at punishing their company with the valuation quite as much as we are.
Right.
So, I mean,
they
one of the
see
things...
it with rose-colored glasses. Everyone sees their company a little bit rosier than it may be.
Sure. So if we do knock the discount rate down some, so let's say I knock it down to, let's call it 6%.
Which would be more in line with the long-term bond.
Yeah, I mean, that still gives you a premium over the current long-term bond yield by about 2%.
Yeah.
You get a current purchase price, if you rerun the numbers, somewhere in the realm of $57.
Which is a very,
American dollars.
Yeah, which is a very big difference.
Which is a very big difference.
Yeah.
And so, at the very least, the management seems to think that their business is fairly valued.
Right. So that's interesting.
That is interesting.
So we'll probably wrap it up there.
Yep.
So I hope you enjoyed this conversation. If you can like and subscribe and leave any comments, that really helps our channel, and we will see you next week.